Okay, quick Monday morning radar update. So, interesting morning for me, just trying to get fuel for the missus's car. Being a key worker, she needs to get to work at stupid o'clock in the morning before the trains start. No luck there. We'll keep trying throughout the day. So, we've got a gap up. Obviously, as we drift towards the zombie hours, these gaps like to, let the gap trade play out. Interesting, the DAX is holding very strong so far. Small caps are strong as well today. Very bearish out there again. It's amazing how people will fight the trend so often and fight valuations and everything to do with what makes money in trading and investing is about going with the flow. But so many out there want to fight everything what makes the money. Moving on. So, not much to see. I would keep your eyes on those inflection points on the dollar, obviously, especially if you hold a lot of miners. I will just jump straight into the volume leaders. It is 10:30. We should have traded 29% to be on average volume. And Oilers are in play today. Obviously, we saw these hit the screens a couple of weeks ago now. The aerospace stocks. Virgin Money hit the swing screen back on this green day here, if you remember. Let's get through these investment trusts. We'll head out, cruise on into the small caps in a minute. CVSG, normal action. Kin & Carter continues, amazing. A few Oilers in there, not the one I'm in today actually. And Travel and Leisure, having a little bit of a go, isn't it? 10:30, 29%, already forgot. So into the small caps. AVG continues. Cornish Metals into the Voodoo average, amazing. The only average what actually seems to have support resistance properties. BG, Merck. This one's, doesn't trade towards what I trade towards, but obviously it's already hugely out of that stage 1, stage 2. Getting paid. Caspian, obviously not the oiler I'm in, but it was the second probably most interesting one we saw, wasn't it, in that area. GKP, reverse vol base. Hurricane. Try not to go too much into soapbox on a Monday. Soapbox day should be Wednesday, but I'll just, the mistakes people make in investing is to chase news days, is to chase popular opinions, and the bigger players what be in the market played a blinder on retail here, and we go back to the day I tweeted about this. Awful action, talked about it. It actually put the high in. It's not about. It's just something I see over and over again, and I mocked out that day. It doesn't make me clever. I didn't put any money on the line on that. I just thought it was a shocking looking stock. So learn from it, I suppose, is the best. Yeah, amazing. Gemfields. BKS. So I'll tell you now, just hop on the soapbox for a minute. I've been sat in front of the screens every day over a decade now, and I've been investing since I was a teenager. I'm over 50 now. And over and over again, I will guarantee that all the best stocks in my account were probably, I learned my sort of, I fine-tuned my methods in a vacuum. But, sorry, a message just came up on my screen then. I learned what works. If you trade in the AIM markets especially, you're going to be trading towards hopes and dreams on companies what don't have anything to show for it. Companies what actually, have turnover and things like that, and they might have pre-tax profit. They might still be trading at a loss, even after that. Whatever. They trade towards growth. Now, if you trade towards growth, aggressive growth, the best growth you can find. Here's something something a bit something you just find over time. I've been doing this a long time. In a fantastic market for growth stocks, you might find that good growth, what trades at actual, pretty okay multiples, is quite sluggish sometimes. In a poor market for opportunities in growth stocks, meaning there isn't that much growth around, you might find that absolute POS small, the more aggressive the growth, the better for me. But you might find that ones that have got, pretty average growth will make bigger moves in the average market. The ones that have got fantastic growth will make in the good market. That's because the pool of growth gets smaller. So, moves will extend your own wildest dreams sometimes. In the worst markets, in the best markets, fantastic looking stocks with fantastic looking growth will cruise on through that period into the next report with pretty average returns. The reason is, how many stocks in the pool of growth there are. So, saying a stock is inferior quality, it should move less, is actually nonsense. It just doesn't work like that. I wish it did. Computers would be, we'd be able to put the details in our computers and we would be able to turn on the AIM cash machine. But no, the markets don't work like that. Another thing, what I will sort of say is, how many people who should know better, who know me quite well, will tell you that buying the high is buying premium and things like that. I will tell you buying the high is the first step of a trend. And if it can't trade that first step, it's not going up, so you're not making any money. So it has to trade the first step. So, getting in Beaks just above £1 here was a pretty good prospect for me. We could have cheated it earlier as well if we wanted to, but stage one is a little bit risky in that area. Adding to the trade, twice already, all the way up, people have talked about the value. And the lesson is, whatever happens in the future, if I tried to value growth stocks, I wouldn't be sitting here today because, the best stocks do not trade at value prices when they are moving. They can bumble around in value while they're on the lows, bumble around in a value area, go through the report and be trading towards a totally different playing field. So I want the stocks to be moving out when they're trading towards growth, gas in the tank. And a P ratio, the market doesn't care. It really doesn't. It doesn't matter what the value is. if, what did I tweet this morning? Growth is the engine, a PE ratio is not the brakes. And over again, every stock I've rode, every big winner has been valued all the way up. People say, buying the high is the wrong thing to do, all the way up. But who's making the money? The people who are riding the trends, because stocks have to trend to make you money. It's as simple as that. If they bumble around sideways, you capture a few dividends at best. But they have to, go in the direction of the position, you take. So you only get paid if the stock is rising. Simple as that. Now, nobody knows which one's going to rise the most. The trouble with valuing something now is that straight away you discount the future. So the future could get worse, it could get better. I'll tell you now, and another thing people will say is they say, oh, last Monday, the social media lights up with, all those highly ranked growth stocks are all getting smashed. No, they weren't. It was very mellow action across in my trading room, everyone seems to be bumbling around close to all-time highs, just a little bit of vol. It's a day when everything goes down together, but come on, So there is absolutely no data I've ever read what can tell you that when the price shock comes out in the growth stock, that it moves down more than a value stock would move down. I will actually put my opinion, is that it does the exact opposite. The value stock with no growth is where the risk is. And how few profit warnings I've had over the years, and how fewer profit warnings have actually stopped me out, is unbelievable. Compared to the researched value, this, value, that. In 2015, it was unbelievable, the ratio of profit warnings. The people who constantly beat this drum about growth gets spanked more than value. It doesn't. Don't believe it. Show me the evidence. Do your own research. I've got the data. I've been trading these for a long time, and I know in my portfolio it's absolutely BS. It's just not a factor. The good thing is the trailing stop has an amazing ability to stop you out of trends. You bank the profits, you compound the account, and then the price drifts off on this X growth stock, and then it dips into that value territory, and then the story begins. Oh, it's this stock is value, and it can't rise on that value. So the end of the day, if you trade growth stocks, do not try to value them. I kind of stick to the GARP principles, but even that's not a strict rule. The reasonings being, when they stop hitting the GARP screen for me, as those who study the GTRS list of mine notice, we're usually heading towards a stage 3, stage 4 maybe. Sometimes, if they're a little bit lower on the list, you get to the stage 2 and they're not ticking the GARP register anymore. But the reality is, good slingshot into a growth stock will give you a huge cushion, and when the bad profit warning comes, you'll use it. It doesn't always stop you out. It's kind of rare it stops me out, to be honest. But we all move forward happier ever after. So, people who've made no money, we've got a huge cushion on this. It's up probably 80% for us, maybe more. I'm not sure. It could half in price tomorrow. Guess what? It wouldn't be a big deal. It really wouldn't. So there you go. That is the reality behind what the job is here. It's to make money. It's not to value things. It's to find the ones what have got gas in the tank, which is quite a funny way of putting it after trying to find gas for the tank this morning. But that is the reality. It's amazing how much you will miss in the markets if you are not prepared to just let the right hand edge play out for you. Leave it there.